Welcome everyone to another episode of The Everyday Trader. This is Greg Jensen. Glad to be with you today. Joined by my cohort, Mr. Hale.
Hey, it's good to be here. And full disclosure, I've had 4 cups of coffee.
Nice.
Yeah, I drank the pot and then fired up the Keurig and made an extra one. I know that you like caffeine a little bit too.
I have downed a full rock star already this morning. So I've got my 240 milligrams of caffeine flowing through my veins. So hopefully we won't bounce off the walls.
This probably explains just the nature of some of our, at least my personality. Some people have to watch my videos in slow motion. So anyways, we'll try to keep things on pace. Talk about what's happening in the market, but pause before we go any further. Do us a favor and subscribe and like and hit that little alarm. So I've had somebody say, actually somebody outside of our universe say, "Hey man, I've been watching your channel. Where's the latest update?" So this one's for you because you didn't bug me, but you commented you enjoyed watching them. So glad to see our audience growing and makes us happy. So let us know, comments, feedback, what you'd like to hear. We have some ideas that we want to talk about today, some things that are going on in the market. Take a look at the markets, look at some economic data, talk about some individual stock stories. Where do you want to start, Greg?
Yeah, let's start with the big news of the day. Let's talk about Netflix. Netflix crushed it today.
Is that the big news of the day?
Yeah, it is the big news of the day. I tweeted yesterday, I'm not sure Netflix can carry the whole market right now, but you know what? I'm being proven wrong today. The market's rallying, and I think Netflix is at the center of that excitement because it's one of the first big up moves we've had on earnings so far this earnings season. I would have to say that, earnings started last week and the banks were kind of mixed. We had, good numbers from Morgan Stanley, really bad number from Goldman Sachs. But this was a really good number from Netflix. And I know, you've been talking about Netflix for a while now. We both have, and how I think it was a little bit overdone, the big sell-off they had last year. And they've been starting to rally this year. They've been a decent stock to be in. And today was one of their first big earnings moves. And you saw it coming. So I wanted to see if you wanted to share what you saw coming.
Yeah, I did. I shared a trade with our advanced subscribers on Netflix. I don't know if it was Wednesday or Thursday, and that trade crushed it. It was an explosively bullish trade with limited risk, and I actually trade Netflix around earnings quite a bit, which is a little bit sort of breaking the rules on what novice traders probably shouldn't be trading around earnings for some reasons that you and I were discussing ahead of time, talking about. We weren't going to talk about it, but I'm going to pop this spreadsheet up and talk real quick. We're not going to go over this, but I think we need to cover this in another class or another session here, talking about normal distributions and theoretical versus observed data. I got something goofy going on in that spreadsheet, but we're going to cover that. But the option pricing models make some assumptions that are wrong, and so traders need to understand. We use models to represent life, and there's places where the Black-Scholes, the option pricing models, break down. And I think the short answer is always be hedged. But there's opportunity here for individual traders to make money if they understand that options are impacted by 3 big things. And one is the stock direction, which pretty much everybody focuses on. But as you and I know, time, and you covered this a little bit in your 6-step review video that you did, which I encourage everybody to go back and watch. That was at 8-9 minutes, is changes in volatility as well. And people talk about volatility, but I don't think a lot of people understand what it is. I'm going to share a chart real quick. You asked, why did I place the trade that I did? So I've traded Netflix bullishly, bearishly, stagnant over earnings. I don't usually do the explosive trades or like straddles or strangles. And the reason is options tend to be overpriced prior to earnings. We see huge increases in the price of straddles and strangles as earnings approaches, because a lot of people are hedging themselves. Some are speculating bullishly, some are buying puts to protect themselves because we get these sort of moves that happened. There's a great story about people, the 300 strike short put, there were about 15,000 contracts sold on the day of earnings this last quarter, or this in April last year. And I was watching that real time because I was trading it as well. Traders the next day who did naked puts were down about $9,000. And as you see, it got worse for those situations. I actually traded through this situation and turned that into a profit. But I didn't see this sort of move happening. I just thought, based on the price action, where technically we are getting close to filling the gap, which is something that tends to happen. It's something Netflix tends to do, is come back and retrace those gaps. And the general bullish trend that was happening technically, and this fall and this year was probably the biggest thing. So understanding implied volatility going down. This means one thing: the price of options are dropping. Why would the price of insurance? Why would the price of options? And it typically does this increase thing. So I think somebody knew something. And so I placed a trade that was limited risk, but had really huge upside on that. And I closed that trade this morning for a nice little profit. These aren't the way that you make a consistent income, but they're nice little trades to do every now and then. You can only do it once a quarter on earnings, but we're in the middle of earnings season. And I think it's important for people to understand how earnings can impact options, and that you need to trade differently. And there's a lot of different ways to trade. And I know, what's your favorite way to trade around earnings?
My favorite way to trade around earnings is a collar trade.
Exactly.
I mean, it hedges my risk. For me, the earnings is a wild card. There's no way you legally know. Now, like you said, somebody knew at Netflix, and so they were out there front running. Whether it's because maybe they have a big position in Netflix and they decided, you know what, we know it's going to happen. We're not going to go spend money on buying protective options through this earnings event. And that's one of those things that's a little bit harder to enforce. I didn't buy insurance, therefore the SEC is going to come crack down on me. But it's another way of having insider information and trading on it.
Well,
Not that it's saying that happened or that I'm encouraging that to happen.
I want to say time out. I don't necessarily believe there's insider information, but there may be much better information. For example, one of the things that is out there, you and I get to see it because we run websites, is web traffic data is pretty interesting. And there's sources that allow us to be able to monitor when people are visiting our websites and get an idea where those sources are come from. Sometimes they're crawlers or web, but sometimes it's real activity. And I think that this analysis, this line of thinking reminds me of one of Jeff Ogden's books. So Jeff Ogden about a decade or two, wrote a bunch of really good books. One of them, he was talking about, what does a retail trader think that they have over an analyst who works for like Goldman Sachs or Morgan Stanley or one of these other big institutionals that has a team of people. Like, he was using Apple as an example, and he said they have people that are parked in front of stores. They pay people to count how many people are walking in and out of the store. So they have dozens of people looking at retail outlets. They use satellite imagery to see who's parking outside Apple stores. They send people overseas to meet with Apple's supply chain to get that information. It's not insider information. It's all out there, but it's not something the average retail trader. So I think with Netflix, I think that there are probably some people who are able to, and it could be as much as, I love Bank of America's data. And one of the things about Bank of America is they get all everybody's credit card transactions. So Bank of America might say, hey, look, all the Netflix, they have access to the data. Like, all of a sudden they see people spending more money. Maybe that's where it came from, is, Bank of America or somebody else who sees these transactions. I mean, these are other sources of data that are out there to the institutions. And we can't know what other people are thinking. Now, maybe you're right. Maybe it was inside information, but I tend to give people, I tend not to go right to the crime, but I do think that there are people who have information that we can't get. But we as retail traders can get tapped into some of this. And I think you and I both know that sentimental data, understanding sentiment, is one of the most valuable things that we can do. And most retail, when you think sentiment, you think emotions and fear. And how do you measure, happiness and that sort of stuff? And it certainly can be measured. It's one of the more fascinating areas, I think, is understanding how to tap into sentiment. And that's specifically what I saw was positive sentiment increasing on Netflix. And so I took a little bit of a calculated risk trade there and placed something that did really well in this trend.
Well, kudos. You knocked it out of the park on that one. By the way, did you see the number they reported? This is kind of a little off topic, but still on Netflix. They said that they estimate that there's about 11 million accounts that actually share their account with another household or multiple households.
I have
what it makes me think is, are they going to try to enforce that? Are they going to start cracking down on that to drive? I'm like, why release that data? But I thought that was kind of interesting.
I'm one of those 11 million because I have 3 adult children, and it actually, I had to change the password because like when they have roommates and then they move, and I'm like, wait a minute, it's like, some interesting stuff. So I've had to, I share it, but I've got 3 adult children and their spouses all using my account.
Yeah.
So there's my wife and I.
It happened. I'm guilty of it as well, and probably the opposite direction. I personally decided I wasn't going to do Netflix anymore a while ago, and so I dropped it. And I saw my daughter watching Netflix, the other day on her phone, and I'm like, "We don't have a subscription to Netflix anymore. What are you doing?" She's like, "Well, Junior gave me his password."
Junior's your son,
so,
right? So
my household is watching. My son, my adult son, who's now out on his own.
I think he's paying family. For it. And I'd be happy to pay if they want to charge me extra money for sharing. That's fine. Or if I need to cut the kids off, I think it's fine. I mean, they all lived here and they had it, and then it was all, and then they've moved out. So I'm all about, I don't want to steal their product. And if they want me to pay more for it, they get it. I think they should be tapping into that. I mean, it makes sense and it's worthwhile. Although the content, kind of, I guess Netflix content is getting a little bit better. Hey, let's talk. What are you watching right now? Is there anything you're loving?
Anything I'm loving? I've finally caught up on all of the Star Wars. I finally watched Andor on Disney Plus.
Yeah.
It took me a while to catch up. I had a busy December. I think I already told you all about that. I had a son get married. We had our summit in Las Vegas. So December was busy. So I kind of fell behind, but finally caught up on Andor. Watched all.
You seen the new Mandalorian 2 trailer? I'm sorry to cut you off. There's the coffee. The Mandalorian 2 trailer is awesome.
I did see that looks amazing. I'm looking forward to Mandalorian. I'm a big Star Wars nerd, always have been. So I will probably always keep my Disney Plus subscription just for that alone. That and Marvel.
Do you watch the animated? I can't get my wife to watch anything animated unless it's like DreamWorks. She loves watching Minions and that sort of stuff. But do you watch the animated Disney?
Oh yeah, all the Clone Wars stuff. Yeah, it fills in. I watched all the animated Matrix series too. Did you ever watch any of those?
No, are those good too?
I need to send them to you. I don't know if you can get them on Netflix. I've got them hard copy disc. They're old school stuff. Yeah, they're really good. They filled in a lot of the stories in the Matrix.
We do know somebody that has access to some stuff that's not. Let's leave that on. Hopefully, we don't want to throw anybody under the bus, but So I'm going to tell you on Apple TV, we just finished Echo 3, and that was good. You really get you wrapped up. It's about a woman who's she's doing research in Latin America, and she gets kidnapped by some Colombian separatist sort of people. And it turns out her husband's a special forces badass, and her brother is too. And so
I'm going to watch it.
Things get pretty, there's lots of, it's pretty, it's really good. That we just finished that one up, and that was and now we're watching on Netflix, we're watching The Recruit, which is a story about a kid who graduates from law school, goes to work for the CIA as an attorney, and he ends up getting wrapped up in into some operations. So Diane really loves that one. But Diane's out of town for the weekend, so it's going to be a bachelor weekend. So maybe I'll fill myself up with. I was thinking about either doing a Lord of the Rings marathon this weekend, but maybe I'll do the Star Wars videos.
Did you watch the new Lord of the Rings one on Amazon? Was it Amazon?
I've watched all of them. I like the series. I know a lot of people didn't like it, and because it's there. One of the things about well, I'm not gonna. There's a little more political correctness in the script. So some things change that, like, if you're a Tolkien fan, I don't know that this would happen this way. And if you can get past that, I know some people seem to get it. We loved it. My wife and I did love the new Lord of the Rings, but it's I think Elon Musk said Tolkien would be spinning in his grave if he saw this. I'll tell you what, speaking of spinning in his grave, is this Tom Clancy, the new Tom Clancy on Amazon. Ugh, it's awful. It is terrible.
Yeah.
I mean, my wife and I are like, we just want it to be over. It's like doing your taxes. We just decided to stop watching it. It's totally unbelievable. And I think Clancy would be, it says based on Tom Clancy, and it's clear he didn't write the script because does not deserve to. It shouldn't have his name on it. I mean, all due respect, I think there's some great actors in it, but I'm not a big fan.
Well, let's I like the Lord of the Rings idea.
We were going to talk about this, but let's talk about some other stuff. Let's talk about economics. Or do you want to talk about something else?
Yeah, no, let's talk economics. Let's talk first of all the Kabuki Theater that's going on.
The what?
The political theater, the garbage.
Oh,
debt ceiling. Yeah. Let's be honest, the debt ceiling game, it's real risk if either side of the party actually had the political will to make the debt ceiling and not raise the debt ceiling, but I don't think any of them would. I don't think they have the will to do it. Let alone, I think they also realize that if they did stop the debt ceiling and don't raise it, there are some pretty serious ramifications of default and the potential of downgrading our debt and the currency collapsing because of that. I don't think that's going to happen. I think this is all a political weapon now, and they're going to play the game and push it right to the edge to try to impact voting and impact relationships in Congress and what they're doing. But it's all a game right now. I mean, the last time they actually did play with it and actually pushed it too far was 2011. And that's when the U.S. got their debt downgraded by Standard & Poor's, and it's never been re-upgraded. And you can see that right there on the screen. We actually have instead of a AAA rating with the S&P with our debt, we're only a AA plus. And that had a pretty bad effect in 2011. The market was really bearish, and ultimately still, though, it ended up creating opportunity to get long the market again with the bearish reaction. And so I think, you said it when we were talking about this morning, it's like, if the market reacts to the actual debt ceiling, I think it's just going to create opportunity to buy the market, because they're not going to hold it for very long. They won't let us default. It's a really big, like 7 sigma event if they actually let us default. I mean, that is the epic stupidity if they did that. So,
yeah. So backing up there, you were talking about the credit rating, and I was sharing Trading Economics is one of these websites that has some good information, and they rank countries based on their credit worthiness, just like companies get rated. And S&P 500, Moody's, Fitch, Dun & Bradstreet, and then Trading Economics has its own numbers. So I exported this to Excel because it makes it easy to sort, and I'm sorting by Trading Economics. But you can see the AAA rated countries that are up here: Australia, Canada, Denmark, Germany, Liechtenstein, Luxembourg, Netherlands, Switzerland, Norway, Sweden, and Singapore all have higher ratings than the United States. And this AA plus, which is pretty good quality, but still not, I guess technically AA plus is above AA. I'm sorting by the trading economics number here, but I just wanted to show that we are not the top rated here. And most of it is this thing that happened in 2011 due to the debt ceiling. Now you have to put in perspective what was going on there too. There was big scandals with the rating agencies. And I think some of this was, well, I think did you say the word theater yet? Because
yeah,
so you did say theater in the beginning. I think part of this in 2011 was theater, and that Moody or S&P 5 or Standard & Poor's sort of pouting and slamming their fist to send a message. It's a little surprising we haven't been upgraded since. Doesn't really affect too much, but this, and that goes to the political theater thing that we're talking about here, and that is this debt ceiling, which is theater. It does have real consequences. It has moved the market, and I was trying to find the data from Bianco because you and I did some research while we were preparing here and came up with some numbers, how many times the debt ceiling has been hit and raised. I know that it's over 100, and I think you said, like, what was the numbers you came up with? 78 since.
Yeah, since 1960 or something like that. So it's 78 times.
So 78 times, and how many times have we raised it?
Every single time.
78 times. So we will raise it. And it wasn't until 1995 when Clinton was president that this was weaponized. So it's normal course of business, and it has been since we've had a central bank, or since we've had a treasury, to have a debt ceiling and to raise it. It's just normal course of business. Not raising it is like spending money in your credit card and then refusing to pay the credit card. You spent the money, you have to pay it. But I don't know if you remember in 1995 when Boy Scouts were on NBC News, nightly news, crying at the Washington Monument because the government shut down and the national park shut down, and the Boy Scouts couldn't get in to see the Washington Monument. And that was just political theater. And we're coming up on it again here. This is something that's capturing the headlines now, and it will be used as a football. We will get through it. And I want people to try and keep calm heads, because it will be spun as a very emotional thing by both political parties and the mainstream media.
Yeah. And so, at some point, you're right. It does have real impact. It can have real impact in markets. But they will raise the debt ceiling eventually. Once they've tooted their political horn long enough and, risk pushing the markets to the edge of crying, then they'll say, all right, we're going to raise the debt ceiling, and done. So I would be cautious of buying into too much of the really, really big doom and gloom stories that are out there about this could be the end of the financial world as we know it here in the United States. It could be, but it won't be.
It will not be. It's folks, just go back a couple of weeks and look what happened with McCarthy becoming speaker. How many votes did we end up having? And that turned into drama, and it was used as a way to negotiate. That's exactly what's going to happen with the debt ceiling. It's going to be used to negotiate something. Both parties are going to use it to their advantage. They're going to throw mud at the other side. But my thoughts are, as the drama is going to reach a fever pitch and markets are going to respond negatively to the sentiment, it's probably going to spell an opportunity for people. If you see the markets pull back on something. Now, it could go on for 6 weeks. I mean, we have had government shutdowns that have lasted that long. And we had one under Trump that lasted a little bit too. So we'll get through it eventually. And how long does it take? I mean, let's just know that this is going to be just a squall. It's not going to be the end of the world sort of thing. So how bad does it get? I mean, we're going to have to keep a monitor and watch the pulse of where things go. But I think it's going to spell an opportunity for any sort of pullback, because I think we'll get through it. And I'm still bullish on the markets.
Agreed. Okay, one more question for you. Economic wise, just stick here. I know we're running long on time. Labor, it's off. Maybe we should do a separate recording on this.
Well, no, we can touch through it. I think we just general economics altogether. I was going to share. This is a website that I like sharing, and it's from advisor perspectives. This is a website that's for advisors that publishes data. So people who like certified financial analysts or registered investment advisors who manage other people. Vetify, who owns Advisor Perspectives, provides information to these analysts. So they do a really nice job. They're my favorite chart. So I encourage people to check it out. But this is, so just scrolling through, because they do a really good job of recent economic reports, is just notice the trend of the charts. So existing home sales going down. Zillow Home Index going down, new housing permits. So a lot of housing data, housing starts going down. Philly, earlier in the week, we got the Philly Manufacturer Fed Index going down. Now, jobless claims, that's going down too. So that doesn't fit. Industrial production trending down, retail sales trending down, gasoline prices trending down, housing market trending down, monthly retail sales, headline PPI, Empire State Manufacturing, sentiment, consumer sentiment, Michigan sentiment bouncing, but still very low. Underlying inflation trending down. Do you see a trend here, folks? The Fed has set the intention of trying to slow down the economy by making inflation go down. Where things don't line up, though, as Greg was mentioning, is the labor market. And I don't know that I have an answer for what's going on, because what were you sharing this morning about the headlines?
Well, yeah, I mean, the headlines are that, you know, we see these strong economic numbers, the labor numbers being reported from the Bureau of Labor Statistics. We see, unemployment rate being extremely low. We see all of the non-farm payroll report. We see all of these big data points that the Fed uses, but yet we see big tech making massive layoffs right now. The latest one overnight, is Google. Google's cutting 12,000 jobs, citing economic reality. And there's a lot, I mean, this goes on the heels of Twitter and Meta and Facebook and Coinbase. And I said Meta and Facebook together, they'll be happy about that. Across the board, we're seeing really big layoffs. Microsoft laying off people just this week as well. So either there's a disconnect here somewhere, and I don't know if it's a demographic thing. I don't know if it's a retirement COVID thing, if it's a sickness thing, if it's an immigration thing. But what I do know is that it still feels like, per looking at the data that the Fed is looking at, that there's a labor shortage, and they're basing some of their decisions on their interest rate moves. This is what they've forecasted to us. They've told us as long as the labor market is strong, they're not going to back off their tighter policy. And that doesn't necessarily mean they're going to keep raising rates. We may be done of the rate increase cycle, but they're not going to lower rates once they get them up to that terminal rate of whatever that ends up being around. So let's say around 5%. That seems to be kind of the consensus amongst the Fed, is that's what it's going to be, is 5%. The market thinks it's going to be lower, but if they go up there and maintain it because of a tight labor market, I guess the question I'm asking, and I agree, I don't know that I have the answer. Maybe this is really one of the core focuses of my research right now, is trying to find, is there a disconnect between the labor market and what's being reported in the unemployment rate and the reality of the labor market? And I don't know the answer right now, but I know it's something that doesn't sit right when I look at reports.
Yeah, it's it's definitely weird. Doesn't kind of fit together. But then again, we've got a weird set of stuff that's never happened before in our economy with a recovering from the pandemic, and we know the labor market still hasn't fully recovered. The work from home phenomenon is real. There's people with side gigs, and but where we are with unemployment, we've never had a recession with such a tight labor market. And I'm wondering here, how much of the forecast for a recession. So if we have a recession, and which the Fed is actually okay with, they're trying to force a little bit of a recession. And I think that might be, I'm wondering, it just occurred to me now, is that why the market, we talked about this dichotomy between what the market is forecasting and what the Fed is saying in terms of this terminal Fed funds rate. It is the market forecasting a recession, and therefore the Fed is going to have to cut rates in order to prevent the pain of a recession. That might be because 65% of blue chip forecasters are forecasting a recession in 2023. And if it's bad enough, the Fed will have to stop raising rates and may have to cut rates. So maybe that's the forecast. I'm not in the camp that we have to have a recession. I don't think we have to. And I don't think that the Fed doesn't want to trash the labor market, but we've heard out of the mouths of Fed members say that don't be surprised if you see a 5.5 on unemployment. I think they would rather keep employment strong and be able to get inflation down. And the metrics look that way. I think the Fed is still talking tough, but I have to think that they're happy with what they're seeing, because we'd rather not see people lose jobs. I don't want to say they're okay with it, but they do expect that could happen. And if they can, thread this needle of a soft landing, being able to get inflation to continue to come down without causing an economic crisis, they're going to be heroes, I think. And that's what looks like it's happening so far. The labor thing is a bit of a, there's something that seems to be missing, and we're not going to get a good update other than, every week we get the unemployment claims. We don't have more data coming until the 1st of February. So the first Friday of February. So Feb 3rd is when we're going to get the next household, the non-farm payrolls and household survey, to get a better understanding of it. But there's something that's going on in labor that we need to keep an eye on. So I think these shorter term high frequency reports are going to getting a lot of attention. I don't have a conclusion other than it's something we need to keep an eye on. Do you?
Yeah, I don't have a conclusion of either, other than I have an underlying concern that, you pointed it out. The economy is weakening. We're looking at across the board a slowing down the economy. Inflation's coming down right now, and yet the Fed is still insistent on raising rates and maintaining that policy of higher for longer. My concern is they're overdoing it, and they are going to make a soft landing turn into a hard landing.
I get a different theory. Go on.
Sorry, what was that? Go ahead.
Yeah, no, on the layoffs, I meant to address this when we brought up the Google thing. I have a different theory on why that's happening. Of course, the answer that there's no other reason to say other than, hey, the economy, we have to let people go. Sorry, you're going to lose your jobs. But I listen to the All In podcast every now and then, which is, Jason Calacanis and 3 of his buddies, Chamath and David Sachs, and who's the other? Friedberg. So there's 4 of them that get together, and they were talking 2 months ago when Elon was laying off, and we might have talked about this, I don't know, but when Elon was laying off people at Twitter, going to cut 75% of the workforce, which is close. I don't know what the numbers are, but estimates are over 50%. And Twitter's humming along, working pretty well, as far as I can tell. I don't know, but those guys said every company in Silicon Valley has to look at Twitter and say, can we cut 50% of our workforce and still function? Because there's probably a lot of fat that's out there that's not adding value. And these guys are, venture capitalists that have money in companies.
Yeah.
And they're saying that their CEOs, the companies they invest in, are saying, look, let's look at Twitter. We might be able to, cut some people here. Of course, the answer is you don't say we have too much fat and we're going to cut. You can't say that. You have to say, oh, the economy, the reality of the situation, we're going to have to let some people go. But I think that the timing, my wife's an HR manager, and she talks about RIFs, reduction in forces, to try and right size their labor, that there's always some portion of the employees that probably need to be or could help the company by culling. So that's GE. That was GE.
And again, not to paint them as these corporatist, evil people that all they care about is profit. They may be truly looking down the road as well and saying, hey, we do see a recession coming and we've got to write our balance sheet. We know we're going to start going in the red if we don't cut staff now, and we want to get out in front of it. So there could be some truth to it's the economy, but I also agree with you. They're not going to come out and say, yeah.
Well, I was hoping we disagree there, because I think the companies look for an opportunity to improve their bottom line, and I don't think as much of it is the economy as they're saying. But there's something weird going on labor. The other data point that I heard is that the average unemployed tech person is finding a new job in 6 weeks. So with especially people in tech, a lot of them can do work from home, so they can find jobs and still work wherever they're at. And so I hope everybody, I don't want to see people lose their jobs. I hope that, especially with this tight labor market, it feels like it's not, I know individually and personally, it's traumatic to have to go through that. But my sense is that it's not a terrible thing yet.
We'll keep you in the loop as we do our research on this labor market, because I agree something's up with it. So I think we ought to wrap up. What do you have anything else you want to throw in before we wrap it up for the day?
We could talk all day, but let's wrap this one up and we'll cover some of the other cool topics later. And I'll see you later on this afternoon for our weekly show for our community.
All right. Thanks everybody again. Just a reminder, subscribe, ask questions, comment. We'd love to make this as interactive as possible, and let us know other things you'd like us to talk about. So thanks everybody.
All right. We'll see you later. Thanks.